I have to be honest with you. When I saw the topic for today's deep dive, I had this really visceral physical reaction.
Oh, yeah.
I saw the word insurance on the schedule, and my brain just it immediately tried to shut down. It's like a defense mechanism.
Hmm.
You hear insurance, and you just think paperwork. You think hours on hold. You think about these bills you absolutely hate paying. It is like the definition of boring.
It is the broccoli of the financial world.
Yes.
Everyone tells you it's good for you, but nobody actually wants to sit down and, consume it.
Exactly. But then I started reading through the stack of research we have today, specifically a book called The Architecture of Risk, and I realized I've been looking at this completely wrong.
Okay.
We aren't talking about filing claims or reading fine print today. We are talking about a survival strategy.
It really is about survival,
Yeah.
specifically financial survival.
Yeah.
The section we're focusing on today has a title that, it really sets the stakes. How not to lose everything.
Which grabs your attention a lot faster than understanding your policy renewal.
It certainly does. And that is our mission for this deep dive. We're going to try and flip the script.
Okay.
We want to take insurance from being this annoying grudge purchase, that monthly drain on your bank account, and turn it into a strategic weapon. We want to understand the mechanics, the architecture, as the author puts it, so we can stop just, throwing money away and start actually protecting ourselves from ruin.
And to do that, you have to get past the boredom. You have to look under the hood. Because once you understand how the machine works, you realize that most people, myself included, until about 2 hours ago, are using it wrong.
So true.
We're over-insuring the wrong things, under-insuring the right things, and paying way too much for the privilege.
It's true. Most people treat insurance like a lottery they hope they don't win, rather than a financial tool they actually control.
So let's pop the hood. The core concept the source material starts with is something called risk transfer. It sounds a bit academic, but it's actually a very practical idea.
It is, and it starts with a hard truth. You cannot live a risk-free life.
Oh.
It is. It's physically impossible.
Right.
You can be the most careful driver in the world. You can eat only organic kale. You can wrap your house in bubble wrap. Bad things can still happen. A tree can fall on your roof.
Yeah.
A genetic health issue can flare up. You cannot stop the event.
Right. You can't control the chaos of the universe.
No, you cannot stop the event. But risk transfer says you can stop the financial shockwave that follows the event. You are essentially saying, I acknowledge this heavy backpack of risk exists, but I refuse to carry it. I am going to hand it to someone with bigger shoulders.
And those bigger shoulders are the insurance company. But this is where I always get stuck in the logic. If I hand them the backpack and you hand the backpack and everyone else does too, how do they not collapse under the weight?
Yeah.
How does the math actually work without them going bankrupt?
This is the mathematics of the group, and it is the only reason insurance exists as an industry. The source uses this great analogy of the auditorium of 1,000.
Walk us through that. I love a good visualization.
Okay, so picture a large auditorium or a concert hall with 1,000 people in it.
Got it.
Now, based on historical data, what we call actuarial science, we know that in the next 12 months, a catastrophic event, let's say a house fire, is going to happen to one person in that room.
Just 1 out of 1,000.
Statistically, yes.
Mm-hmm.
But here is the problem. We have no idea which one. It could be you, it could be me, it could be the guy sitting in the back corner. It's a lottery, but it's the worst lottery in the world.
Yeah.
If you win, you lose your house. You are financially ruined. The cost to rebuild is, say, $500,000. Nobody has that sitting in their checking account.
So everyone is just sitting in this room sweating, hoping it's not them.
Exactly. The tension is high. So they make a deal. They pool their resources. Everyone agrees to put $500 into a pot.
Okay.
Now you do the math. 1,000 people times $500.
That's $500,000.
Right. Now, for 999 people in that room, that $500 is gone. They paid it, nothing bad happened to them, and they don't get it back.
And that's the part that feels like a waste. That's where the grudge purchase feeling comes from. I paid $500 and got nothing.
It feels that way.
Mm-hmm.
But for the one person whose house burns down,
Oh.
they get the entire pot. They get the $500,000 to rebuild. The many pay for the few.
So when I pay my premium, I'm not really paying for my house directly. I'm paying a subscription fee to be part of this community safety net.
Yes.
I'm trading a small, known loss, the premium, to avoid a catastrophic, unknown loss.
That is the perfect way to put it.
Yeah.
You are trading certainty for uncertainty.
Yeah.
You know you will lose the premium money. That is 100% certain.
But in exchange, you eliminate the risk of a loss that you just couldn't recover from. That's the fundamental architecture.
Okay, so that's the theory. And honestly, when you put it that way, it sounds noble. It sounds like a community supporting each other. But let's get into the practice, because this is where the source material starts getting critical of how we, the consumers, behave.
Yeah.
We're bad at navigating this architecture because the language is, it feels designed to confuse us.
It is dense. It's legalistic. But there are really only two levers you need to understand to hack this system: the premium and the deductible.
Let's break those down. The premium is the subscription fee we just talked about.
Right.
The cost to get into the room.
Correct. That's your monthly or annual bill.
But the deductible, or the franchise, as it's sometimes called in the source text, this seems to be the place where people make the biggest mistakes.
Huge mistakes. The deductible is the amount of money you agree to pay out of your own pocket before the insurance company pays a dime. It's your skin in the game.
So if I have a car accident and the repair is, say, $5,000, and I have a $500 deductible, I write a check for $500, and the insurer writes a check for $4,500.
Simple enough. But here is the strategic insight that most people miss. There is a seesaw relationship between the premium and the deductible. When one goes up, the other goes down.
And the source suggests this is where the life hack lies.
It is the single most actionable takeaway for saving money on insurance. Most people are loss averse. They think, if I have an accident, I don't want to have to scramble for cash. I don't want to pay anything. So they choose a super low deductible, maybe $50 or $100.
Right.
They want the insurance company to cover everything from $1.
Which sounds nice in theory. It feels safe.
It feels safe, but it is expensive. To get that low deductible, the insurance company charges a massive monthly premium. You are paying a fortune every single month for the privilege of not paying $500 later.
You're bleeding cash flow to protect yourself from what is really a minor inconvenience.
Precisely. The strategic move, the hack, is to bet on yourself. You raise your deductible, you go to your insurer and say, you know what, if I crash, I'll cover the first $1,000 or even $2,000.
And in exchange,
Your monthly premium plummets. I've seen cases where raising a deductible from $250 to $1,000 cuts the premium almost in half.
half. That's significant.
It's huge.
Yeah.
And here's why the math works in your favor.
Yeah.
Remember the room of 1,000 people?
Yeah.
Statistically, you probably won't crash this year, or next year, or the year after that. So if you take the high deductible, you are saving that premium difference every single month.
Let's put some numbers on this. Let's say I save $50 a month by raising my deductible. In a year, I've saved $600.
Right.
In 2 years, that's $1,200.
And that $1,200 is yours. You keep it. If you don't crash, you are way ahead. And even if you do crash after 2 years, the savings you accumulated cover the higher deductible anyway.
So the strategy is maximize your deductible to the limit of what you can comfortably pay from your savings.
That's the caveat. You need to actually have that $1,000 in the bank. If you don't have an emergency fund, a high deductible is dangerous. But if you do have some savings, keeping your deductible low is literally throwing money away.
Wow.
You are paying the insurance company to hold on to your own money.
That's a powerful reframing. You're paying them to manage a risk that you could easily manage yourself.
And that violates the core principle of the architecture. You only transfer risks you cannot handle. You handle the small stuff. They handle the catastrophes.
This leads us perfectly into the psychological side of things. Because even if the math makes sense, raise the deductible, lower the premium, people still hate paying for insurance.
Oh, absolutely.
It feels like throwing money into a void.
It feels like a subscription to nothing.
The source material has this phrase that just stopped me in my tracks. It calls insurance the bet you want to lose.
It's a paradox, isn't it?
Yeah.
Every other time we spend money, we want something in return. If I buy a coffee, I want to drink it. If I invest in a stock, I want it to go up. We are wired for return on investment. We want to win the transaction.
But insurance just it breaks that wiring.
Completely. Look at life insurance. It's the starkest example. You pay a premium every month. What is the condition for winning that payout? What has to happen for the insurance company to write the check?
Well, I have to die.
You have to die. So if you reach the end of the year and you are sitting there alive, healthy, having dinner with your family, you effectively lost the bet with the insurance company. They kept your money.
And people get so angry about this. I hear it all the time with car insurance, too. I've been paying State Farm for 10 years and never had an accident. I've wasted thousands of dollars.
That sentiment is the psychological trap. It's viewing insurance as a product transaction money for goods. But insurance isn't a product.
It's a service.
It's a service.
And the service isn't the check they write when you crash. The service is the absence of fear while you drive.
The absence of fear.
Think about it. If you didn't have car insurance and you knew that one mistake could cost you $50,000 and bankrupt your family,
Yeah.
how would you drive?
You wouldn't.
You'd be terrified. You'd be sweating every time you merged. You wouldn't let your kids in the car.
It would be paralyzing. I probably wouldn't drive at all.
But you aren't paralyzed. You drive to the store, you sing along to the radio, you don't worry about every little thing. Why? Because you paid for the privilege of not worrying.
Right.
You paid for the knowledge that if the worst happens, you are covered. That peace of mind, that is what you bought.
So if nothing bad happens, you didn't waste your money, you successfully, you consumed a year of security.
Exactly. It's like buying a fire extinguisher. You buy it, you mount it on the wall. If 5 years go by and your kitchen never catches fire, you don't look at the extinguisher and say, what a waste of money. I wish I had a fire so I could have used it.
No, you say, thank God I didn't have to use it.
But you were happy it was there.
Yeah.
That is the mindset shift. Stop looking for a financial return on your premiums. The return is that you get to sleep at night.
That is actually really liberating. It takes the resentment out of the bill paying. But, and this is a big but, this only applies if you are insuring the right things. You should only be paying for the absence of fear regarding things that are actually scary.
Correct. If you are paying for the absence of fear regarding a broken poster, you're doing it wrong.
Which brings us to Sean's rule. I don't know who Sean is, but I like his style.
Sean is the author of the section we were reading, and his rule is simple. Only insure what can ruin you.
Only insure what can ruin you. That seems to cut through all the marketing noise we get bombarded with.
It's the golden rule of risk management. There is an entire industry designed to sell you insurance for things that cannot ruin you.
I'm looking at you, extended warranty people.
The extended warranty on the toaster, the screen protection plan for the smartphone, the insurance on the flight ticket that costs $50, the protection plan for the headphones.
Okay, let's apply Sean's rule to the smartphone. I buy a new phone for $800. The salesperson pressures me to get the $12 a month protection plan.
Ask yourself the question, if I drop this phone in the toilet tomorrow and it is completely destroyed, will I be financially ruined?
No.
Will I lose my home? Will my children go hungry?
No. I mean, I'll be annoyed. I'll be really mad at myself. I might have to use an old cracked phone for a while or dip into savings. But ruined.
No. Then do not insure it. It is, and I'm quoting here, mathematically stupid to insure it.
Mathematically stupid is harsh. Why is it stupid?
Because insurance companies are not charities. They're casinos. They have done the math. They know exactly how often phones break. They price that $12 a month so that they make a massive profit on it.
Right.
Over 2 or 3 years, you end up paying nearly the cost of a replacement phone in premiums alone.
You're prepaying for a disaster that might not happen.
And you're doing it at a premium price. If you take that $12 a month and put it into a savings account, call it your clumsy fund or your stuff breaks fund, you are essentially becoming your own insurance company. You are self-insuring.
And if I don't break the phone, I keep the money.
You keep the profit. The insurance company doesn't get it. You accumulate that cash.
So, if we are cutting out all these small policies, the gadgets, the travel insurance for cheap trips, the appliance warranties, what are the non-negotiables? What falls under the must-have list, according to Sean's rule?
The source highlights the big three: health, house, and liability.
Health and house seem obvious. Medical bills can be astronomical, and for most people, their home is their biggest asset. If that burns down, you're at zero.
Right. Those meet the ruin criteria perfectly. But the third one, liability, is the one people sleep on. And it's arguably the most dangerous.
Define that for us. What are we talking about here?
Liability is your legal responsibility for damage you cause to others. Let's say you are driving and you cause a serious accident that injures a surgeon.
Oh, wow.
Or you have a guest at your house, they trip on a loose step, fall, and sustain a permanent injury.
We're talking lawsuits.
We are talking massive lawsuits. Medical bills, lost wages, pain and suffering. This can easily run into the hundreds of thousands, even millions of dollars.
And that is definitely ruin.
It's worse than ruin. It's future ruin. If you lose a lawsuit like that and you don't have enough insurance, the court can garnish your future wages.
No way.
They can come after assets you haven't even earned yet. You could be paying for that one mistake for the next 20 years.
That is terrifying.
And yet, so many people carry this state minimum liability on their car insurance just to save a few bucks. They'll insure their phone, but they'll drive around with only $25,000 of liability coverage.
So following the architecture, You should skimp on the phone insurance, skimp on the toaster warranty, but max out your liability coverage.
Absolute maximum. It is usually incredibly cheap to add an extra $500,000 of liability coverage compared to insuring a phone. It's the best value insurance you can buy, and it protects you from the biggest threat.
It's funny, isn't it? We obsess over the visible risks. Oh no, my screen might crack. And we ignore the invisible ones. I might get sued for $1 million.
It's human nature. We fear what we can see. The architecture of risk is about using math to override that fear. It's about being rational in an emotional world.
So let's try to synthesize this for the listener. We've covered a lot of ground, and I want to make sure we lock this in.
Let's do it.
We started with the idea that insurance isn't just paperwork, it's a community safety net, a way for the many to protect the few from ruin.
The mathematics of the group.
Then we talked about the lever, the relationship between the premium and the deductible. And the strategy there is clear. Accept a little more pain up front, a higher deductible, to stop the monthly bleeding of high premiums.
As long as you have the savings to cover that deductible, that is key.
Right. Then we shifted the mindset. We stopped looking for a payout and started valuing the absence of fear. We realized that if we don't use the insurance, we actually won because we enjoyed the safety without the disaster.
It's a bet you want to lose.
And finally, Sean's rule. The filter for every decision. Only insure what can ruin you. If it won't ruin you, self-insure. Keep the money.
It's a complete framework. It takes you from being a passive payer of bills to an active architect of your own safety.
It really changes the feeling of opening that renewal envelope. Instead of feeling helpless, you can look at the numbers and say, does this fit my architecture? Is this efficient?
You become the CEO of your own risk department.
I love that. CEO of your own risk department. Now, before we wrap up, the source material had one final provocation that I think is worth leaving people with. We talked about buying peace of mind.
Yes. And this is the challenge I want to leave you with.
Go for it.
I want you to look at your bank statement. Look at the insurance payments going out for your phone, your pet, your old car, your appliances. And ask yourself, are you truly buying peace of mind? Or are you paying for laziness?
Oof. That stings a little.
It should.
Right.
Are you paying that premium because you are genuinely afraid of the financial hit? Or are you paying it because you just don't want the hassle of dealing with a problem if it arises? Because there is a difference between risk transfer and inconvenience transfer.
Inconvenience transfer. That explains so many bad purchases.
Insurance is too expensive to use for inconvenience. It is designed for catastrophe. If you are using it to avoid hassle, you are overpaying for your life. True financial peace comes from having a strong savings account for the hassles and a strong insurance policy for the disasters. Don't mix them up.
That is the question to ponder. Are you insuring your life or are you just insuring your lifestyle?
Huge difference.
Listen, this has been an eye-opener. I'm definitely going to go look at my liability limits and maybe cancel a gadget warranty or two.
Good plan.
Thank you for guiding us through the architecture. And to you listening, thanks for diving deep with us. Go check those deductibles, take control of the risk, and we'll see you on the next one.